Good. So where did we stop in our last class? Where did we stop? Which question did we solve last? Hmm? Okay. We have not solved the pursuit co.
No, sir.
Okay, let's solve pursuit co. Let's start with pursuit co for this night. Very important. Okay. We solve half co. Okay, so this is the question we want to look at. We are starting with tonight. And after this question, I go straight to that Ejideko. These are the two questions we are going to solve to round up our discussion on merger and acquisition. Are you with me? Hello, are you there?
Yes, sir.
Yes, sir.
Okay, so let's go to the requirement of this question. Let's go to the requirement of the question. In this question, we are required to prepare a report to the board of directors of Pursuit Co. that 1, evaluate whether the acquisition of Foda Co. will be beneficial to Pursuit Co. and its shareholders. The free cash flow to firm method should be used to estimate the value of Foda Co. and the combined company, assuming that the combined company's capital structure stays the same as that of Pursuit Co. current capital structure. Include all relevant calculations. And Requirement B says we should discuss the limitation of the estimated valuation in part 1 above. And Requirement 3 requires that we estimate the amount of debt finance needed in addition to the cash reserve to acquire Foda Co. and conclude whether Pursuit Co. current capital structure can be maintained. And Requirement 4 has to explain the implications of a change in the capital structure of the combined company to the valuation method used in part 1 and how the issue can be resolved. 4, we have to assess whether the chief financial officer's recommendation will provide a suitable defense against a bid from SGF Co. and will be a viable option for Pursuit Co. So we have 5 different requirements we want to address here. We have 5 different requirements that we want to address. Let's go and read the question so that we know how to approach each of these requirements. Pursuit Co., a listed company, which manufactures electronic components, is interested in acquiring Fodaco, an unlisted company involved in development of sophisticated but high-risk electronic products. The owner of Fodaco are a consortium of private equity investors who have been looking for a suitable buyer for their company for some time. POSUCO estimates that a payment of the equity value plus a 25% premium will be sufficient to secure the purchase of Fodaco. POSUCO will also pay off any outstanding debt that Fodaco holds. POSUCO wishes to acquire Fodaco using a combination of debt finance and its cash reserves of 20 million, such that the capital structure of the combined company remains at POSUCO's current share capital structure level. The down to this information is that POSUCO want to acquire Fodaco, and the people want to pay is estimated to be 25% of the equity value for Fodaco. I'm also told that the acquisition of Fodaco, POSUCO want to achieve it by using a mixture of debt finance and paying cash. So the company currently has 20 million cash in its reserve. And please give me 1 minute. I told bring it. Bring it. Sorry, guys. So let's continue. So we want to make the acquisition of Fodaco using our cash reserve of 20 million and paying the parts or the remaining balance using what? Using debt finance. So this is the cash reserve here. So in terms of this cash, issue debt in order to acquire Fodaco. So we now have information on POSUCO and Fodaco given to us here. Now for POSUCO, we are told that POSUCO has a market debt to equity ratio of 50-50. What does this mean? This simply means the current gearing of POSUCO. So this is the current gearing of POSUCO. POSUCO is financed 50% by equity and 50% by debt. And an equity beta of what? 1.18. POSUCO has a total firm value, which is market value of debt and equity combined of 140 million. What does this mean? This is the corporate value that you can see, firm value. Firm value is the same thing as corporate value. And that is market value of equity plus market value of debt. So what does it mean? It simply means that this question has already given you the valuation of POSUCO. So POSUCO's total market value, which is corporate value, is 140 million, and it is 50-50 geared. So if I may ask, What do you think will be the value of equity for such a company that is having a firm value of 140 million and a gearing of 50-50? What will be the market value of equity of such company? Are you there? Can you answer that question? Can you answer that question? No. We're not talking.
No. No.
You cannot answer it. Why won't you be
It
able
should
to
be
answer?
50%.
Over 140.
50% of 140.
I wonder why you cannot answer it now. When they give you gearing 50 and they give you total market value, that's the simplest question that you should be able to answer. So debt is 50% of 140. Equity is 50% of 140. That's what it means. Now, we now have information of what? FODACO. We have income statement extract for 2011, 2010, 2008, 2009. What happened? So with you. Sorry. Okay. Why's my laptop misbehaving? So we have all amounts in $1,000. We have our sales revenue, operating profit after operating cost and tax allowable depreciation. So we have net interest cost, we have profit before tax, we have our taxation, we have after tax profit, we have dividend, we have retained earnings. FODACO has a market debt to equity ratio of 10 to 90 and an estimated equity beta of 1.53. It can be assumed that each tax allowable depreciation is equivalent to the amount of investment to maintain current operational levels. However, FODACO will require an additional investment in asset of 22 cents per naira per $1 increase in sales revenue for the next 4 years. I think we have treated a similar question like this under Okaoko, right? Have you gone through the solution of Okaoko? Have you? Who has gone through the solution? Nobody. Okay. Now, it is anticipated that FODACO will pay interest at 9% on each future borrowings.
So which solution? Is there a solution for this one?
Solution for Okaoko now. I didn't say this one.
Oh, okay.
Solution for Okaoko. Nobody has gone through it.
I've gone through it.
Just know that your exam is less than 1 month. So for the next 4 years, FODACO sales revenue will grow at the same average rate as the previous years. After the forecast 4-year period, the growth rate of free cash flow will be half the initial forecast sales revenue growth rate for the foreseeable future. We have information about the combined company. Following the acquisition, it is expected that the combined company sales revenue will be 51,952,000 in the first year. That's the information of the combined company now. That's after the acquisition of FODACO. Okay. Following the acquisition, it is estimated that the combined company sales revenue will be 51,952,000 in the first year, and its profit margin on sales will be 30% for the foreseeable future. After the first year, the growth rate in sales revenue will be 5.8% per year for the following 3 years. Following the acquisition, it is said that the combined companies will pay annual interest at 6.5% on future borrowings. The combined company will require additional investment in assets of $513,000 in the first year, and then 80 cents per $1 increase in sales revenue for the next 3 years. It is anticipated that revenue growth rate, it is anticipated that after the forecast 4-year period, each free cash flow growth rate will be half the sales growth rate. It can be assumed that the asset beta of the combined company is the weighted average of the individual company's asset beta weighted in the proportion of the individual company's market value. Okay. Other information. The current annual government base rate is 4.5%, and the market risk premium is estimated at 6% per year. The relevant annual tax rate applicable to all the companies is 28%. Okay. SGF interest in Postal Co. There have been rumors of potential bid by SGF Co to acquire Postal Co. Now, this is another information entirely. The previous information we went through is for Postal Co and Fodder Co. In those information there, Postal Co want to acquire Fodder Co. But in this information you have here, SGF Co want to acquire who? Want to acquire Postal Co. You can see the link. In the information we went through before, Postal Co want to acquire Fodder Co. But in the new information before us here, SGF want to acquire Postal Co. So there will be rumor of potential bid by SGF Co to acquire Postal Co. So financial press reports that, some financial press have suggested that this is because Postal Co's share price has fallen recently. SGF Co is in a similar line of business as Postal Co, and until a couple of years ago, SGF Co was the smaller company. However, a successful performance has resulted in its share price rising, and SGF Co is now the larger company. The amount of SGF interest have raised doubt about Postal Co's ability to acquire Fodder Co. Although SGF Co has made no formal bid yet, Postal Co's board is keen to reduce the possibility of such a bid. The chief financial officer has suggested that the most effective way to reduce the possibility of a takeover will be to distribute the 20 million in its cash reserve to its shareholders in the form of a special dividend. Fodder Co would then be purchased using debt finance. He concluded that this will increase Postal Co's gearing level, but suggested it may increase the company's share price and make Postal Co less appealing to SGF Co. Now, if you look at this question, you see that it's large enough to intimidate you, Abby. The question is large enough to create intimidation threat. But if you know the technique for answering question, you know that this question should not pose any threat to you at all. Now, if I want to answer question number 1, which is requirement 1 here, where I was asked to what? To evaluate whether the acquisition of Fodaco will be beneficial to POSUCO and its shareholders. What does the question want me to do here? You want to compare the market value of POSUCO after the acquisition of Fodaco with the market value of the two companies before the acquisition. So my starting point is to compute market value of POSUCO, compute market value of Fodaco, add it together to get my pre-acquisition market value of the two companies. Then after that, I will now use the post-acquisition information given to me in this question to compute post-acquisition market value. So I will remove the pre-acquisition market value from the post-acquisition market value. If the difference is a positive figure, I will say the acquisition is worthwhile. If, however, the difference is a negative figure or a near zero figure, then it means the acquisition is not worthwhile. Do you understand that explanation?
Yes, sir.
Okay. So let's go and solve requirement 1. You can see, where do I have your? This will have to pass. Started this madness again. Look at what he's doing. Please 1 minute. Let me bring my mouse. Okay, sorry. I just need to go and bring my mouse. This laptop is misbehaving. Okay. So I think I should be fine now. So let me go open our. Okay, I think I have it already. Okay. Okay. So question number what is this? Example what?
Example 7.
Example 7, okay. So requirement 1. Don't forget this is supposed to be a report. I'm not going to write a report to. So this one is supposed to be appendix. Computation of acquisition gain or gain, composition of gain on the acquisition of Fodaco. So the first thing you need to do is to compute pre-acquisition market price. Okay, compute, where did I go to? Pre-acquisition market price. So let me start with Fodaco. Now, if I want to compute the market price of Fodaco, where will I go? I simply go to the question and look at the section where I'm given the information of Fodaco. That's all. I don't need to be going through all the whole question, because the question has already been sectionalized. If I want to do for Fodaco, I go straight to where I have information about Fodaco. Where do I have that? This is information of Fodaco. This is it. Okay. This is information of Fodaco. What's wrong with this, my laptop? So this here we have information of Fodaco. Let me highlight it so that will serve as a guide to us from here down to continue. Okay. So let's see. Let's read the information now on Fodaco. We have Fodaco income statement extract. Fodaco income statement. Extract.
Sir, your network is breaking.
So we have the historical information for 4 years, 2008, 9, 10, and 11. Let me move this way, the structures. Now, how do we apply this historical information? So you go to add under the additional information to that financial statement. The question will tell you how you should compute the market value. The question cannot keep you in the dark. It's left for you to be able to read through and understand what the question wants you to do. If you look at this now, we're told that Fodaco has a market debt to equity ratio of 10 to 90 and an estimated equity beta of 1.5. It can be assumed that tax allowable depreciation is equal to the amount of investment needed to maintain current operational level. However, Fodaco will require additional investment in assets of 22 cents per 1 naira increase in sales revenue for the next what? For the next 4 years. Look at it. For the next 4 years. If I'm currently in year 2011, and I tell you for the next 4 years, which year am I telling you to apply? Which year will you apply? If I'm in 2011 and I tell you for the next 4 years, which years will you apply?
2012 to 2015.
Good.
So,
2012 to 2015. To compute your income statement, your free cash flow to go for how many years? To go for 4 years. So year 11, year 10, 2011, 2010, 2009, 2008. They are historical figures. And I always tell you that whenever you are making a valuation or you are computing cost of capital, you need future cash flow. I've always been telling you this right from day one. I've always been telling you this. All the figures they give me here, they are historical. If I want to carry out my valuation, I need future cash flow. So I need to go and recompute this statement, revenue. I will come here, look at my revenue. These are my revenue. But what I need to do with this is that I will just look at from year 2008 to 2011, what is the average growth rate in revenue? On the average, by what percentage has my revenue been growing? When I get that percentage, I will now grow the 2011 sales using the average growth rate. So in other words, the only thing I need to pick from this information is what? Is the average growth rate in sales. So let's go and see how we will do that. Average growth rate in sales. Average growth rate. Okay, average growth rate in sales. Now, I can use my interpolation of historical figures. The same formula we use under the dividend valuation model. I can use it to compute my revenue growth rate. Right? Average growth rate in revenue, which is G, will be equal to what's our latest revenue? Come and pick your latest revenue. My latest revenue is 16. Is that correct? Yeah. 16,146. So 16,146 over what about the first growth rate in 2018? That is 13,559. Put it there. 13,559. Close the bracket here. When you are done, raise this to power. How many years do we have? 4 minus 1, that's 1/3. 1/3. Then everything minus 1. Everything minus 1. That's a policy. So everything minus 1. So G will be equal to, let's calculate. I believe we are with your calculators. Where's my calculator? Oh. Where did I put my calculator? 1 minute, please. Okay, have you gotten it? What do you have there? What do you have? I have 16,146 over 13,559. Everything here raised to power 0.33 minus 1 times 100. We have 5.9%. 5.9%. That's the growth rate in sales revenue. That's the growth rate in sales revenue for this month. So what would I do? I will come here. Let me go and put a table so that my work will be easier. Year 1, year 2, year 3, year 4, year 5. So I have my year here. Yes?
This question, they didn't give us the growth rate. That's why we are computing the growth rate, right?
Yes. I'm not giving growth rate for Fodaco. Do you understand?
Yes, sir.
1, 2, 3, 4. I'm not giving growth rate for Fodaco. So revenue, we now go and pick current revenue. Our current revenue is revenue in 2011. That's our current revenue. Revenue in 2011. What's the revenue in 2011? We don't have the book of it. So revenue in 2011 is 16,146. 16,146. Let me see. Let me see if that's what I'm supposed to do. Let's see where first year. If you are given revenue in the first year, it means I will start my first year with further course make the okay. Come in. Okay, we are not given first year revenue, so we are going to grow. We grow this one times 5.9%. Everything here raised to power n. Everything raised to power n. So in year 1, it's going to be 16,146 times 1.059. That's what? 17,099. Approximately 17,099.
Excuse me, sir.
Yeah.
What is the 5.9 for?
You said?
9%.
You said what?
This is my breaking.
Ask your question.
It's breaking. Okay, I
Let's
thought you
continue.
want
17.
that's
So 17099 times 1.059. That's giving me 18108. 18108. And for year 3 is 18108 times 1.059. That's giving me 19,176. 19,176. And the last one is 19,176 times 1.059. That's 2307. So that is our revenue. Hello, who is that? I was having problem logging to my page. I have to just join normally. So if you are the admin, you need to transfer the host to me. I was finding it difficult to log into my account for me to sign in again. So please check if you are the admin. Transfer the admin right to me so that I'll be able to share my screen. So I did not log in normally. I just joined the way people have joined because I was having problem logging in. Are we there? Hello? Oh. Hello? Hello? Hello?
Hello, sir. Hello, sir.
Yeah. Yeah. Did you hear what I said? Did
No,
you hear what
sir.
I said?
No, sir. What happened?
I said I was having problem logging into my account. You know, I used
Okay.
to log into my account to start the class. Now I wanted to log in and rejoin the class. I was not able to log in. So I have to join the way you people joined. So you have to check if you are the admin. The moment the network logged me out, the system will have made one of you the admin. So check if you are the admin. You need to transfer the admin right back to me so that I'll be able to share screen and do other
Okay.
necessary.
Mrs. Shen is the admin now.
Okay.
Have you done that?
I've done that, sir.
Okay, thank you. I said, I don't know. Just so sorry for the network glitches, please. So these are the revenues. I hope every one of us understood how we got these revenues, have you? Who did not understand how we got those revenues? Everyone understood. Okay, so let's continue. Now, after we have gotten our revenue, the next thing is to be able to either compute our cost or to compute our profits. So let's see what information we have here to be able to compute either our operating cost or our operating profit. Let's go to the question. Okay. It can be assumed that each times allowable depreciation is equal to amount of this. Okay. Come. Okay. Now, we are not given any information that will enable us to compute our operating profit because, you know, we computed this one by growing our revenue, Abby. So it does not mean that we now have to start growing all others. No, that's not what we're going to do. This is what you do. We have to go and compute our profit margin from here using the last year here. Compute your profit margin. How do you compute your profit margin? What's our profit before tax here? Profit before, yeah, these are profit before tax, have you? These are profit before tax, which is our operating profit. So divide this figure here by the sales revenue so that I'll be able to know the margin of your profit. So let's see, profit over sales is what we call margin. 4,680 divided by 16,146. So my margin is 28.9, or approximately, I can call it 29%. That's my profit margin. That's my profit margin. Okay, that's my profit margin. So it means that if I come back to my solution here, my operating profit should be what? Should be, you see 29, what do I call it? Yes, 29% of my sales. If my profit, 29% of each of these sales will represent my profit. So operating profit at what? At 29%. So 29% of 17,099. 17,099 times 0.29. 4,959. 4, 9, okay, it's profit, not cost. 4,959. And for this. Okay, 4,959. Then 29% of 18,108 will give me 5,251. 5,251. Then I come here, 0.29 times 19,176. That will give me what? 5,561. 5,561. Now here we are going to have 0.29 times 20.
5,889.
Okay, 5,889.
And yes, sir.
Did we all understood how we got this operating profit? Who did not understand? You know, normally you are supposed to deduct expenses from revenue to get to operating profit, Abby. But because there is no basis for me to compute my expenses here, I can simply compute my profit margin. I will now apply the profit margin on each of the revenue to get my operating profit. It's as simple as that. Now, if this is my operating profit, now, my operating profit is this. That is, now, after that, what next do? We need to charge our tax. What's the rate of tax? What's the rate of tax in this question?
28%.
Eh?
28%.
28%, okay. tax at 28%. So 4959 times 0.28 is what? 1386.
One, 389.
89. Oh, okay. 1389. Then here, 0.28 times 5254 will give me what?
1470.
And this is 5561 times 0.28. We have
1557.
1557. 1557. 5889 times 0.28. 1649. These are the taxes. When you are done with taxes, what do we now do? We now start computing our free cash flow. We can start computing our free cash flow now. Okay. Udako has a market debt to equity ratio of 10 to 90. Hello, are you there? This figure we pick is not correct too.
Sir.
What we pick is not operating profit too. See our operating profit. This is our operating profit too. That's what they give us, the operating profit. Look at it here. That figure we pick is not correct.
Okay.
This is operating profit, not this. Please, let's go and adjust that.
Okay.
5169. Mrs. Angela, are you sleeping? Are you people sleeping?
I'm here. I'm not sleeping.
Mrs. Angela. Mrs. Angela is sleeping.
I'm not sleeping. No.
Okay. So let me just give you that profit margin so that in case you want to, you should remember it. Operating profit margin. Operating profit margin. That's calculated as operating profit over what? Over 6 times 100. So that's going to be operating profit margin
Which is 5.
equal to what do we have there? 5 what?
5169.
5169 over 16146. 5169 over 16146 times 100. That's what? 5169 over 16,146. 0.32 is 32%. It's 32%. We're supposed to have 32% and not 29. So 0.32 times 17,099. 5472. It's supposed to be 5472. 5472. Then operating profit. Why am I putting in brackets? Move you. So 0.32 times 18,108. So what do we have there? Yes, I'm coming. What? 5795. 5795. Then for this one is 0.32 times 19,176. That gives us 6136. 6136. 6136. And the last one is 3307 times 0.32. 9698. 9698. So these are the operating profits. These are the, don't forget, your operating profit is what? Profit before interest and tax. Abi? That's what that one means. That's what that one means. So our tax is going to change. 5472 times 0.28. 1532. 1532. Then here is going to be 0.28 times 18108. We have 5070. Then we have 19,176 times 0.28. 536. Yeah, I can hear you. Yeah.
We are computing tax on profit before interest and tax. That's not, year 2 is not correct.
It's not correct, Harry. What's it
Yes, sir.
supposed to be?
1623.
1623.
23.
Okay. 1623. What about year 3? 6136 times 0.28 will give us what? 1718, have you?
1718.
1718, okay. Thank you. And this one is what? 9698. 9698 times 0.28. That's 2715, right? Is that correct? Have you confirmed those figures?
Correct, sir.
Okay. So the reason why we are charging tax on operating profits, which is profit before interest and tax, is because we want to compute free cash flow to firm. Okay. I think is that the requirement? Let me see.
Sir,
Yeah.
that year 4
I can hear you.
figure correct.
It's not correct.
That
Okay, I'm
year
coming.
4 operating profits.
I'm coming. Look at it. The free cash flow to the firm method should be used. Can you see that? That's the free cash flow the question wants you to use. That's the reason why we charge our tax on what? Profit before interest and tax. So which one do you say is not correct?
That one,
This one here.
yeah, it's 32% of 2307 will give us
Yeah, it's what?
6498. Confirm it.
649, I will confirm it. 0.32 times 2307. Okay, 1698. 6498 rather. Okay, thank you. That's correct. So times 0.28. That will give me 1820.
20.
Okay, thank you. Thank you. So it means you are following me. 1820. 1820. Okay. So when we are done, what next? If there is any non-cash item, what do you do? Add back no cash item. Let's go to this question and see the information we have. Okay. You can say it can be assumed that each tax allowable dividend is equivalent to the amount of investment needed to maintain current operational levels. So the implication of this information is that, normally, here I'm supposed to add back my non-cash item, Abi. So this question is now saying, if you add back your non-cash item, you are going to deduct what? Capital expenditure and what? And working capital, right? So this question is now telling me that the amount of working capital investment needed is the same thing as what? Is the same thing as capital allowance. So if I add back my capital allowance and I deduct my, what do you call it? And I deduct my working capital requirement, I will still have 0. So I don't need to go and do add and deduct, because what we're adding back is the same thing you are going to deduct. That's the implication of this statement here. I want you to look at that statement very well and see whether you understand what it means. Aside what I said there, look at it, whether, don't deceive yourself. If you don't understand it, let me know. Look at it very well. The one I highlighted, look at it very well and make sure you're able to interpret it. Did you all understood it? Hello?
Yes, sir.
Why? Nobody talked.
Yes, I talked. I said
So,
yes.
You've explained it.
Yeah.
Hello, sir. The steady network in Jesus' name.
So, however, further code will require an additional investment in asset of what? 22 cents per what? 22 cents per 1 naira increase in sales revenue. So I'm going to compute additional investment based on incremental revenue. That's what the statement means. For every 1 naira increase in my revenue, I should suffer an additional investment of 22 cents. So also look at that statement and let me know whether you understand it or not. Do you understand that statement? Hello? I assume you all understood it. So let's go. Let's go and compute our incremental revenue. Let's go and compute our incremental revenue. I'll go and put that one under working note. Let me go down and show it as working note. Workings. Additional investment. Additional investment. Oh no, I didn't save this now, it has closed. Can you imagine all the work I've been doing? Oh God, why is this laptop doing me like this? I don't think I saved.
Yes,
Okay.
sir. Thank God.
Thank God. Oh.
So save it now.
So working. Okay. Working one, additional investment. Additional investment. So let me use table. Yeah, 1, 2, 3. You know what? Come on, no problem. Let me just go and do what that we are. So I have year 1, year 2, year 3, year 4. So I'll bring down the revenue. Do you have the revenue? Can you give me? I don't want to be going back and forth. What is the revenue there? 17,099.
Yeah. 18,108.
18,108.
108.
Yeah.
19,176.
19,176.
2307.
2307. 2307. 2307. So this one is the total revenue here. I will now go and find the incremental revenue because that's what the question tells me, that for every $1 increase in revenue, there's going to be 22 cents working capital additional investment. So I will go and compute my incremental revenue. So let's do that. Incremental revenue. Here there's no increment. Okay. I think there's incremental. Let me see. I'll give one for the first year. Now, our incremental revenue for the first year is the difference between the revenue you have here, this one here, the one with that we grew, 14,146, and the one you have for year 1, 14,146 minus 17,099 is going to be your increase in revenue for the first year. So let's get that clear. we have 17. $17,099 minus
16,146.
16,146. That's 953.
95.
Yeah, thank you. 953. So for here, we have 18,108. 18,108 minus 17,099. That is 1,009.
09.
Then this is 19,176. 19,176 minus 1,8,108. 1,068.
068.
And the last one here is 3207. 3207 minus 19,176.
113.
11,031.
1131. Network in Jesus' name.
Mrs. Shah,
Is it okay? You need to transfer the host.
what is happening to the platform today? I'm not able to log in directly.
Network.
Yeah, the use now, sir.
Yeah, I've seen that. So, additional investments at 22 cents. So, just be multiplying those incremental by what? By 0.22. That's what it means. So, what will you have for year one? 0.22 times 953.
210.
You said?
210. Approximately.
So, let's multiply. What do we have for the first one? 0.22 times 953 will give us what? 210 approximately. I will have 210. For this one, I have 1009 times 0.22. That's 222. And here I have 1068 times 0.22. We have 235.
235.
And the last one is
249.
So these are the additional investment needed. These are the additional investment needed. These are the additional investment needed. So I go straight and put it there, 210, 222. Additional investment. Sorry, this network is really dealing with me. It's dealing with me. Oh. No, I get the network at all. Oh,
So why don't you change to another one?
I've changed to my wife network, do everything. Still the same thing. I've used 3 different networks today. Okay. So we have 222 as that 210 here, 222. What is the remaining 2? 1068 and sorry, 235249.
So we are not seeing your screen.
You are not seeing it.
I'm not seeing it.
Okay, I'm coming. Can you see now?
Yes, sir.
Okay.
We've not seen the page.
So we have, can you see it now?
We can see your worksheets.
Ah,
The word is something else you are saying. Chat, private conversation.
you can see my worksheet.
Yes.
What are you not seeing?
Something like chats. Start a new chat. Like a private chat and call you. I don't know. Or is anyone seeing something else?
It's the same.
Let me reshare again. Can you see it now?
Yes, sir.
Yes, sir.
Okay. So we have 235249. Two 35 and 249. All these should be in bracket because they are what? They are additional investment, right? So they are all outflows. I put them in brackets. So let's see whether there are other costs that we need to include. For the main 4 years, it is aware that further code will pay interest at this. After forecast 4 years, the free cash flow will be so. That is all the cash flow we need to sort. You see that this is actually very short. The cash flows are not many. The cash flows are not many. So from here, I get my free cash flow to the firm. Free cash flow to the firm. So what do we have? Year 1 is what? Well, calculate it and give me the figure. What do we have?
Year
What do you
one,
have in year one?
3730. 3730. Year one.
Okay. 3730. Year two.
3950.
3950. Year three.
4183. 4183. 4183.
4183. And the last one.
4429.
12.
4429.
4429. So these are the free cash flow to the firm. What do you need to do to this free cash flow? You can tell me. You know, we are not interested in computing free cash flow. What we are interested in is what? Computing market value. So what do we do with this cash flow now?
Discount it.
You said?
We discount.
Discount.
We discount. So we need to discount this cash flow using WACC. That's what I wanted you to say. We need to discount it using WACC. We need to discount it using WACC. Let me show this one up. Let me also move this one so that we have more space. Okay. So discount factor DCF at, so we need to go and compute our
WACC.
We need to go and compute our what do I call it? Our cost of capital. So let's go and see how we were to compute cost of capital for Fodaco. We're told that Fodaco has equity beta of what? 1.53, right? 1.53. So I will go and use that to compute cost of equity. You don't need to say you want to redeem and redeem. We don't need to redeem here because what you are doing does not require computation of business risk. It's when you want to compute business risk or you want to remove financial risk from a beta of equity that you're on GA. There's nothing of such in this question because this question of merger and acquisition. So we just pick our beta, which is 1.13. We use to compute cost of equity. You see that all the information I'm picking here, I'm picking information from Fodaco. So I come to note 2. Cost of capital for Fodaco. Now, the beta of equity is given as 1.53. So on JD, the beta of equity the beta of equity using using the gelling of Fodaco. So I have my cost of equity to be equal to 1.53 plus what's the beta of equity? Oh, sorry. What's our risk-free rate? I think we are given this rate somewhere in the question. Where is it? I think it should be done. General information. Coming. I'm trying to figure out the risk-free rate.
4.5.
4 points. Where did you see it?
The last other information. Where you have other information.
Okay. Other information. Okay. So other information, the base rate is 4.5 and the market return is 6%. So I have 4.5 plus beta of 1.53 market return, which is okay, the premium is 6%. The premium is 6%. So evaluate the what we have. What do we have as a cost of equity? Give me the final figure. What do we have as cost of equity?
13.6.
Ma?
13.68.
13.68%. What about cost of debt? Let's go and pick it. This man pay, you see, the only information we have there is the fact that this man pays interest at what? Let's see. Under
9%.
9%. So the only thing you need to do is just convert it to after tax. The journey is 90/70, sorry, 10/90. 10 for debt, 90 for equity. Am I correct? So cost of debt will be equal to 9% times 1 minus T.
0.8.
What's our T? Let me put it directly. 0.28. So we're going to have 0.62 Let me confirm that, please.
0.72.
0.72, Abby?
Yes, sir.
Okay. Are you sure?
6.48.
6.48.
9 times 0.62. 6.58.
48.
48.
How did you get 42?
Yeah, approximately.
9 times 0.62.
0.72, sir.
2 point what? Is this figure correct?
No, sir,
Um,
it's
0.48.
6
0.48.
point,
48.
okay, 6.48%. That's our cost of debt. So what's the gearing? Gearing is 90% equity, and for the other one, this equity and the value of debt is 10%. So we have 10 for value of equity. Then what's going to be the WACC? Have you got some customer? Hello?
Sir.
I'm coming. Response to some, please. 5 minutes. Have you got some people? Okay. I will get in touch after the class, please. All right. Okay, let's continue. So what will be what? Our cost of equity times market value of equity over what? Market value of equity plus market value of debt plus cost of debt. We have already converted it to post-tax, Abi, times market value of debt all over market value of equity plus market value of debt. So what will be equal to, what's our cost of equity? Our cost of equity is 13.68% times market value of equity is 90. Is that journey correct? Are you sure the journey is correct? It's correct, Abi? Let me see you. Okay, it's correct. 1090. Okay. Just need to be sure. So everything here over 100, that's equity plus debt, plus cost of debt 6.48%, 6.48% times 10 over 100. So my WACC will be equal to, so let's calculate our WACC, 13.68 times 90 divided by 100, that's 12.3%. Then plus 6.48 times 10 divided by 100. What we are 0.65 approximately. So add these two together, my WACC will be equal to 12.3 plus 0.65. So this is 12.95%. So that is the WACC. So let's say 30% approximately. So we are going to discount this cash flow here using what? Using 30%. What is 30% here? 1.13 raised to power minus 1. 0.885. Zero point, this is not correct. It should be 0.885, not 995. 0.885. So the second year will now be raised to power minus 2, 1.13 raised to power minus 2, 0.783. Then 1.13 raised to power minus 3, 0.693. Hope you are doing it alongside with me. So the last one is 1.13 raised to the power of minus 4. 1.13 raised to the power of minus 4. That's please, what do you have for your calculator? This one is give me rubbish.
0.613.
613, okay, good. 0.613. Where's it going to? Okay, 0.613. So let us now discount. When we discount, we have our present value. What is the present value here? 3730 times 0.885. So I have 0.885. I have 3301.1. 3301.1. Where am I putting it? Sorry. We have 3301.1. Then year 2, 3950 times 0.783. I have 3092.85, 3092.85, 0.85. Then the next one is 0.693 times 4183. So I have, is this correct? 4183, okay, it's correct. I have 2898.82. 2898.82. And the last one, 4429 times 0.613. We have 2714.98. 2714.98. So what is the market value here? Which is the corporate value? We are completely corporate value because we have used what? What type of cash flow do we use? Sorry, free cash flow do we use? We use free cash flow to the firm. So there's need to compute corporate value before we can compute market value of equity. So let me remove this. Yes, as I move the other one, I join. Oh, what will eliminate this? I'm coming. Let me eliminate this. Delete entire row. Okay, good. So if this is a corporate value is equal to corporate value is equal to addition of all the present value 3730 plus 3950 plus 4183 plus 4429 16292. So to compute corporate value, I have present value year 1 to 5. So year 1 to 4. That will give you 16,292. 16,292. 16,292. Now, after this, we are given information on free cash flow. Look at it. After the forecast 4-year period, the growth rate of each free cash flow will be the half the initial forecast sales growth rate for the foreseeable future. What is the question telling us here? After this period of 4 years, we are, let me see, the free cash flow to firm is expected to grow at what? Half of the initial growth rate of revenue. So you now ask yourself, what rate did you use to calculate our revenue? We use 5.9%. So half of it is the growth rate of free cash flow after the 4-year period. So it therefore means that in addition to this.
Sorry, sir, please what's your PV column?
What do you say?
PV.
Your
This
PV,
one?
yes, for after the discounted cash flow.
Hey. What happened to it? Okay, I know what to do. Let me go and shift this one up a little. Yeah, I think we are fine now. We are fine now. Now, PV of year 1 to 4. Add everything together. Let me re-add it to confirm. 3301.1 plus 3092.85 plus 2898.82 plus 2714.
12.
Is what?
12
This one
zeros.
This one is point.
Yeah.
0.98.
12007.75.
Okay, 12007.75. Yeah, good. 12,007.75. We now compute present value. Present value, year 4 to infinity. Year 4 to infinity. So we are going to use perpetuity here. Is perpetuity will go. So we are going to have free cash flow in year 4, which is 4429. 4429. I will go that by half growth rate of free cash flow is 5.9/2. So I will have 2.95% as a growth rate. So I will have into bracket 1.0295. Everything over. What's the cost of capital? 0.13 minus the growth rate, which is 0.0295. So discount factor of the base here is 0.613. So when we evaluate this, we get our figure. So let me do this.
No, this one is not clear.
Which one is not clear?
This 1.0295.
1.02, where is it? Which are you talking about?
The present value year 4 to infinity.
I can't hear you, ma.
The present value year 4 to infinity.
Okay, 2714.9 is not correct, Abby.
The present value year 4 to infinity.
Okay, year 4 to infinity. Sorry, it's not year 4, year 5. Year 5 to infinity. There are so similar questions like this now. Not even 1, not 2. So after the 4th year,
So
this free cash flow will be growing. And we have discussed annuity and perpetuity when we did this, sorry.
Is the 1.029 she's asking of?
What do you say?
How did you get the 1.029?
0.029.
The
1
growth,
point.
the growth rate.
0.029.
Growth rate. She's asking how you got the growth
Wait,
rate.
I don't understand what I'm saying. Wait. What's the revenue growth rate?
5.9%.
What's the instruction here? The one highlighted down here. The one in blue.
Half the initial forecast sales.
Then divide that by 2 now. So growth rate of free cash flow to firm will now be equal to that 5.9% over what? Over 2. That's what gave us 2.95. You understand? Eh?
Yeah.
Okay. So this will now be 4, 4.
What of this 4, 4?
What of which one?
4, 4.
Is it not this one I transferred there? This one now. It is year 4. You have to go this one to perpetuity. That's one I transfer now. Year 4 figure. It's what I'm going to go to perpetuity.
Why don't you write the formula so I can at any time
I've written a series of formula on this. Go and check the previous note. Many formula have been written on this. Many formula have been written on this. So I don't support writing formula all the time. Honestly, if I write 2, 3 formulas, it's enough now. I have to be writing formula all the time. I will say, okay, this one is a free cash flow to frame year 5 into bracket 1 plus G. So if I write this one again, if I want to solve language, I will still repeat the formula again.
Sir, can we skip formula in the exam?
We have work. Our work is what? Is R minus what? Minus growth rate. That's what I repeated here. Times discount factor of what? Discount factor of the base year. That's what I repeated here now. So our
Sir,
sorry for year this year for what do you say?
can we skip formula in the exam to save time?
You can speak formula now. Who want to mark your formula? Who is marking your
You don't
formula?
mark formula.
Who is marking formula? Who has time to marking formula? So it's difficult you got that the examiner is interested in formula.
You don't
Nobody
mark.
is marking formula. If I just writing many formulas, you are just wasting your time.
Final figure they are looking for.
Not giving you any mark. One single mark like this, formula will not give you.
Ah.
So if you know your formula, the way I put it there, just put it there. Your final answer is what the examiner want to see, not the formula you have written. You can never see in the marking scheme correct statement of formula. Have you ever seen it in Pathfinder, the marking scheme? Have you ever seen where they say correct statement of the formula, 2 mark? You can never see it now. So that simply means that your formula does not attract any mark. So this is the formula I replicate, I applied here. This is the free cash flow for year 4, okay? This is my what? Growth rate. The growth rate of 2.95 is this. My work is 30%. My growth rate is this, 9.5, 9.5. And this is the discount factor of the base year. What do you mean by the base year? Base year is the year from where we are bringing this 4429. Okay? We are bringing this 4429 from year 4. So year 4 is our base year. That's all. So we now evaluate. And we have 4429 into bracket 1.0295, close the bracket, over, I want to calculate the value once, over open bracket is 0.13 minus 0.0295, close brackets. What do we have? So I would now multiply by 0.613. So everything there is given 27,812. Okay, let me say 27,811.63. 27,811.63. So when you add these two together, when you add these two together, you get the what? Corporate value. That's the corporate value. Go and look at your business valuation. All this, that's why I always tell you, if you don't know business valuation, there's no way you can. All this what we are doing now. We have not even done anything major and acquisition. All this one I see your business valuation that you have covered. I've not done anything major and acquisition here at all. Or do you see anything major here? No. All what I'm doing here, you see business valuation, no anything of major and acquisition here yet. So I will beg you to go and pick your business valuation and understand it. If you think you just want to brush over business valuation and you not jump to major and acquisition, it does not work that way. Ensure you understand business valuation before you move to major and acquisition. So I have 12,007.75 plus 27,811.63. What is the total there? 39,819. 39,819.38. That's the corporate value. If this is my corporate value, What will now be my market value of equity? Market value of equity. You know, what is our journey? Our journey is what? 90% equity, 10% debt, Abby. So I put the one that is for equity, 90% equity. So it's 90% of the total corporate value, which is 39,000. Are we there? Hello?
Yeah,
Yes.
yeah, sir.
Okay. So 90% is our journey. Our journey is 10% debt, 90% equity. So that proportion is what I'm going to apply to get your market value of equity. Take the percentage, which is 90% that is meant for equity, use it to multiply the corporate value. You get the one that is meant for what? Equity holders. So that 9819.38. So market value of equity is 0.9 times 39,318.38. We have 35,386, 35,386 point 526.54. That is the market value of equity of a folder. Any question on this? I think it's either we go to bed because of tomorrow's office.
Yes, sir.
Hemojeri, Mrs. Shehu, I know you are waiting for me to say it. Are you going to office tomorrow?
No, I'm not.
I think you are working from home.
Yes, sir.
So you have time to sleep tomorrow now. What about me that I have to leave my house now?
Working from home too is not easy. Can you just call you at any time to do something?
Working from home is easy because you are not facing all those crazy traffic.
Yes, that's just it.
So that's it. So do you understand this or any question from this? Mrs. Angela, please, are you there? Are you there, ma'am? Hello?
Yeah.
Go and
here.
watch those videos on business evaluation, please. Go and watch those videos again, especially on free cash flow. Especially on free cash flow, to ensure that you understand all this multi-stage growth rate. If you see this one now, we have present value from year 1 to 4. We now have present values from year 1, from year 5 to infinity. So all this one have been covered under free cash flow model. And even under economic value added with these similar things. Abi, Shebu, we did economic value added in this class, Abi?
Yes, sir.
So under economic value added, we apply the same formula. So by the time you go through the sessions of those videos, it should be much more clearer to you. But if you have your way, don't waste your time stating formulas. I'm repeating it. If you know what you want to put down, it's not necessary you write down your formula so that you can save some considerable amount of time for yourself. Mrs. Chiu, any question?
No, sir.
No, Abby? Okay. Can I call it a day?
Yes, sir.
When are we meeting again?
Well, we should. Are we okay.
You said?
I thought we had to meet tomorrow. Tomorrow is Monday.
I've told you now that
Okay, no problem.
I cannot determine. It depends on how the workload is in the office. But I will try. I will see. Maybe I will try to squeeze out time tomorrow for us to meet, if it will be possible. I will try and see what I can do.
If the workload
Okay.
is much, we can fix. You can still do
Fix
it by this time.
time. Yeah.
Eh? After facing traffic, I will get home by 9 o'clock. I will not start later again. That is not possible. If I want, that's why I said, if I want to take you this time, it has to be weekend. It can never be weekdays. Yes, sir. It can never be weekdays.
Yes. Lagos traffic.
The earliest time I get home is 9:30, 10:30. If I give that traffic and I don't get to, I say I want to start, I will just be deceiving you. In fact, I will be sleeping while teaching you. I mean, you want that? You want me? I should be sleeping, so I will just be teaching you from my dream.
Oh, sir. Did
So,
you take the exam this weekend?
yes, I take exam this weekend.
Child.
I wrote entrepreneurship yesterday. I wrote environmental business today. So the exam is going to be 3 weekends. So we have 2 weekends left.
Child. The Lord is your strength.
No.
You have a lot. You have a lot.
I have what?
I say you have a lot. So
It's not that I know.
I thought you're also preparing for ACC now.
I
thought you're preparing for ACC.
Yes, that one is in March.
Okay, next month. Next year.
Yeah. It's in March. I'm writing December.
Okay.
So thank you. I'll see what to do. If I'm going to meet tomorrow, I will communicate early to you so that you can get prepared.
Okay,
But don't worry. You know, after this one, we have one topic left, Abby. Sorry, one question left for merger and acquisition, right?
Yes, sir.
So if we can arrange 2 more Sundays before your exam, like this time now, Sundays 2, before your exam. And of course, I don't have time. FCA lecture is going to...
Do we have left?
You said?
How many topics do we have left?
FCA lecture is going to end on November 7th. Are you with me?
Yes, sir.
FCA lecture will end on November 7th. So we should have time by then to concentrate on other topics. So if before then, I'm going to ensure that we do 2 more Sundays. Yes, sir. We'll do 2 more Sundays. But for the 2 Sundays, we're going to cover bond valuation, portfolio theory, and option pricing theory. Option pricing theory, I've already covered half of it. Don't forget. Abby?
Yes, sir.
I've already covered half of option pricing theory. So the remaining half, we are going to cover it. We cover portfolio theory. We cover bond valuation. So I will now know that the only topic left will be hedging. So we'll do hedging last. So the moment we start hedging, maybe we'll do hedging until you go to exam. If I tell you I'm going to finish hedging, I'm just not being fair to you. We cannot finish it because it's too wide. But we are going to do it.
What of that mock?
I sent it to you now.
The solution.
The solution.
Oh, solution, okay. I've not sent the solution, Abby.
No, sir.
I will send the solution tomorrow by God's grace. I will send it tomorrow.
Okay, sir.
Or even tonight. I can even send it after this class. I'll send it.
Okay, good night.
Okay, let me know. Have you solved it already? No, Abby?
I've not, sir.
Yeah, so if you have not solved it, I will not send the solution. So solve it before you get solution. That's why it is called mock.
Okay, sir.
It's not classwork.
Okay, sir.
Right, sir.
Attempt it on test or ability.
Mm.
Test or ability. I will now send the solution. So I'm not going to send the solution yet. Go and attempt it first.
Okay, sir.
Thank you.
Yeah,
Have a
thank
peaceful night rest.
you.